Current market data indicates that NVIDIA Corporation is trading at exactly $180.26, having secured a gain of $2.44, representing a 1.37% increase during the most recent active session. While the markets may be paused for the Thanksgiving holiday, the post-session sentiment remains electrifying, and the tape tells us that the bulls are refusing to hibernate. The stock is hovering near its all-time highs, showing a resilience that defies the typical gravity of a $4 trillion asset. Most investors look at this price action and see a company that has already won the race, assuming the massive gains are in the rearview mirror and that the law of large numbers will soon act as a ceiling. That is the expectation, that trees cannot grow to the sky and that the semiconductor cycle is due for a violent correction. The reality, however, creates a fascinating tension that you need to understand right now. The reality is that we are not witnessing the end of a hype cycle, but the early infrastructure build-out of a completely new asset class, sovereign intelligence. What the general public perceives as a simple chip stock is rapidly morphing into a utility provider for national security and global economic survival, effectively decoupling its demand curve from traditional consumer electronic cycles. While the bears scream about valuation and the skeptics worry about hyperscalers like Meta or Google building their own silicon, NVIDIA is quietly engineering a lock-in effect through its software ecosystem that makes the switching costs virtually insurmountable for the next 5 years. This discrepancy between the fear of a peak and the reality of a deepening moat is where your opportunity lies, and we are going to tear apart the numbers to show you exactly why. Let's analyze the immediate price action we are seeing on the chart. That move to $180.26 is not just random noise. It is a structural rejection of the bearish thesis that emerged earlier this month. We saw a dip recently following reports that major customers might be looking to diversify their hardware, yet the stock absorbed that selling pressure and reversed higher. When a stock refuses to go down on bad news, that is a primary signal of underlying institutional accumulation. We are seeing massive volumes changing hands, not just from retail traders using a Robinhood app or speculating with Robinhood fractional shares, but from heavy institutional heavyweights reallocating capital from software to hardware. The volume profile suggests that every time the stock dips below the 175 level, programmed buy orders from major funds kick in, effectively creating a floor. This is what we call a buy-the-dip regime, but it is driven by pension funds and sovereign wealth funds, not just the momentum traders you might see on social media. This brings us to the elephant in the room, the expectation that big tech companies will abandon NVIDIA for their own in-house chips. You hear this constantly. The narrative is that Amazon, Microsoft, and Google will simply design their own replacements and NVIDIA's margins will collapse. That is the fear keeping many of you on the sidelines or parked in safe, low-yield Fidelity mutual funds. But let's look at the reality of the situation. Designing a chip is one thing. Building a software stack that millions of developers already know how to use is completely different. NVIDIA's CUDA platform is the sticky factor that the market continues to underestimate. Even if a competitor builds a chip that is 10% faster or 20% cheaper, it doesn't matter if the trillions of dollars of existing code cannot run on it efficiently. This is why, despite the headlines about competition, NVIDIA's data center revenue continues to accelerate. The reality is that the largest companies in the world are not just buying chips, they're buying time. They can't afford to spend 2 years optimizing code for a new architecture when the race for artificial intelligence dominance is happening in real time. They will pay the premium for NVIDIA because it works today, right out of the box. Speaking of paying premiums, let's discuss the recent earnings, which literally shattered the ceiling of what was thought possible. We are talking about $57 billion in revenue for one single quarter. To put that in perspective, that is more revenue in 3 months than many S&P 500 companies generate in a decade. The expectation going into the report was high, but the reality was off-the-charts demand for the new Blackwell architecture. The company explicitly stated that demand for Blackwell exceeds supply and will continue to do so well into next year. This crushes the air pocket thesis, the idea that there would be a pause in buying before the new chips arrived. There is no pause. Customers are buying everything they can get their hands on, both the current Hopper generation and the upcoming Blackwell chips. This dual demand dynamic is rare in hardware cycles, where usually the announcement of a new product kills sales of the old one. Here, the desperation for compute power is so high that corporations are taking whatever inventory is available. It is critical to address the volatility we see. You might wake up one morning and see the stock down 3% because of a macro report or a yield spike, and you might feel the urge to panic sell. This is where having a steady hand and perhaps using tools like Fidelity Wealth Management or consulting with Schwab Intelligent Portfolios can help keep your emotions in check. Volatility in a name like this is the price of admission for the growth you are receiving. If you are managing your own capital through a Fidelity brokerage account or using Interactive Brokers trading platforms, you have to treat these intraday swings as noise within a broader signal. The signal is that capital expenditure budgets from the largest companies on Earth are increasing, not decreasing, and almost all of that increased budget is flowing into one single company's coffers. I want you to pause for a second and think about your own positioning. Comment below how many shares of NVIDIA you currently hold, or if you are waiting for a pullback to enter. It is always interesting to see where the sentiment is among real investors versus what the analysts are saying. Now, let's dissect the circular revenue concern that bears love to bring up. The argument is that NVIDIA invests in AI startups, and those startups then use that cash to buy NVIDIA chips, creating a false feedback loop. While it makes for a sensational headline, the reality is that these investments are a tiny fraction of the overall revenue pie. The vast majority of sales are coming from well-capitalized, cash-rich tech giants and increasingly sovereign nations. This sovereign AI theme is the next leg of the bull case that is vastly underappreciated. Countries like Japan, France, Canada, and nations in the Middle East are realizing that they can't rely on American tech giants for their intelligence infrastructure. They need their own supercomputers to train models on their own languages, laws, and cultural data. This means NVIDIA is no longer just selling to 4 or 5 tech companies. They're selling to huge government entities with practically unlimited budgets printed from their central banks. This diversifies the revenue base and reduces the risk of a single customer pulling back. We also need to talk about the physical constraints of this trade. It's not just about designing the chips, it's about packaging them. The CoWoS, chip-on-wafer-on-substrate packaging capacity at TSMC, has been the bottleneck, not demand. As that capacity comes online over the next 12 months, we are going to see a massive release of pent-up revenue that hasn't even hit the books yet. The expectation is that growth will slow because of the law of large numbers. The reality is that supply constraints have been artificially capping the growth rate, and as those corks are popped, the numbers could surprise to the upside yet again. This is a supply chain story as much as it is a technology story. If you are looking at the broader semiconductor sector, you might be tempted to look for the next NVIDIA using tools like SoFi Investing or browsing Fidelity ETFs. You might look at AMD or Intel and think they are cheaper, but in this specific paradigm, cheap is often expensive. The gap between the leader and the runners-up is widening, not shrinking. While diversification is generally good advice, and you might use Schwab Intelligent Portfolios to achieve that, in a winner-take-most market, the leader often captures over 80% of the profit pool. NVIDIA's gross margins are hovering in the mid-70% range. That's practically unheard of for a hardware company. It indicates pricing power that rivals the most exclusive luxury brands in the world. They are selling the shovels in the gold rush, but these shovels are made of diamond, and only one smith knows